Okay, welcome back. We're going to start today's session with a paper by Daniel Shaviro. Dan is the Wayne Perry Professor of Taxation at the new NYU School of Law. He's one of the nation's leading legal scholars on tax policy. In particular, he's written an outstanding book on transitional issues in tax reform. Longtime advocate of progressive consumption taxation, especially its benefits in terms of tax simplification. And today, he's going to address the issue of how the politics of consumption tax reform might impair the end product, perhaps robbing it of many of these simplification benefits.
I was noticing yesterday how there was a question asked to Larry Koplikoff about, well, aren't you going to wipe out the value of ES Planner if you do this? And I was thinking, well, the nice thing about the fact that today, if I've been an advocate of progressive consumption tax reform, is that I can say it's not going to work after all without any worry that it'll affect the end result, since we know the policymakers aren't listening anyway. So I'm free to have a lot of courage and to just call it as I see it, because I know it won't have any effect anyway. Okay, anyway, my disclaimer is I have to say I really enjoyed writing on this topic, which was assigned to me by the organizers, but I wouldn't have kind of chosen it myself because the question, it presupposes something that I kind of don't really expect, which is that a progressive consumption tax will actually be enacted. And well, I know Larry yesterday said 0.8 for the national retail sales tax. I have to say my estimates for all of these are considerably lower. So I thought the question is not what do I think is going to happen, but how would it happen if it does happen? And in the paper, I think I used instead the Monty Python question, what if Queen Victoria could fly? But here instead I say it brings to mind there's a debate in Catch-22 between two atheists about whether the God who doesn't exist would be merciful and kind or cruel if he did exist. So I kind of have that feeling about writing the paper a little bit, in the sense that I'm examining how something would happen. I don't really think that it will. So what I decided to do was to try to pick plausible scenarios for how it would happen if it did. So the first one I pick is kind of a bipartisan 1986 style process that leads to a progressive consumption tax. And that's kind of a natural thing to think about if you see it happening. Some readers of my first draft said, oh, but it's not going to happen. And I have to say they have a point, very possibly. What are some of the problems with it? One is it really takes a bipartisan process like in 1986. Today, in 2006, we're very, very far from that type of bipartisan political process where the two parties are willing to cooperate. It might just be cyclical. It might be just where we are now, but it also might be structural. There might be changes in, I discussed this not in this paper, but I've written about it elsewhere, of why it might be that this is kind of the new world, where basically the Tony Downs scenario of people fighting for the center is no longer really defining political activity anymore. Second question is, would the Democrats ever do it? It takes two to tango, and even the Republicans are willing to do this. It kind of makes a lot of sense. Just like 86, it's progressive, but it's a consumption tax, which the Republicans want. But would the Democrats ever sign on to this? And right now, the answer is certainly no. But if we assume that it actually happens, it might have to be bipartisan. And here I think of there's been a debate in evolution. They say, how can it be such a coincidence that all the conditions for life on Earth, the conditions for life to exist on Earth are very demanding, and they're all met here? What a coincidence. And some people would think this shows that there's a divinity at work or something. But it was pointed out on the other hand that although it's extremely unlikely for any planet to have those conditions, on any planet where you have living things looking to see if the conditions are there, they'll inevitably find that they're all there. That being so, if a consumption tax happened, this thing that seems unlikely might need to have happened. So that's kind of my defense. We're kind of in a world where it actually does happen. Or a little less metaphysically, think of the way I think of it is, if you have someone with the kind of cleverness of Bill Clinton in '92, planning to run for president in a couple of years and show I'm not an old-style Democrat. In '92, I doubt this was so. Today, it would be true, I think, that someone like Clinton '92 would have this idea would be among the menu he'd look at. Personally, I think he'd probably figure the politics aren't good enough, but he'd look at it. It would be on the list of things to consider. And you think about things like, the Democrats would never do welfare reform, a la '96 they did. So in principle, one could imagine this happening, though I really don't think that it will. Well, if that's my first scenario, I have to pick a progressive consumption tax, and I select the X tax as a better bet than a consumed income tax. So let me just take a detour to say something I meant to say earlier. I realized that the structure of the contours was the known, the knowable, and the unknowable. I kind of say at the beginning of the paper, basically, politics is a huge chaos system. No one can really predict anything. So as a result, I feel it's purely in the realm of the unknowable. Maybe that's a little too flip because I'm trying to describe things that are politically plausible, and there might be knowable truths about how the political system operates and so forth. But fundamentally, I think I'm in the realm of the unknowable because it's how would the politics of the enactment of a consumption tax impair the end product, and that depends on how a fundamentally unpredictable system would operate. So that's why I kind of, instead of bolding known and unknowable, I've decided to put myself in the unknowable realm from the start. Okay, I meant to say that earlier. Returning to the scenario here, progressive consumption tax, the natural ones to pick are the X tax or the consumed income tax. I'm not trying to make a value judgment here between the two. I select the X tax simply as a more likely scenario. It's been more prominent recently. For example, as everyone knows, the tax reform panel's GIT was using it as a starting point. Something I'll return to later, there's a perceptual problem, and I emphasize the word perceptual, not real. You have an individual level tax in the X tax, and it taxes wage earners, or taxes collected from wage earners is observed being collected from wage earners, but tax is not observed being collected from so-called coupon clippers, people who have, just live off dividends or interest or capital gains or something like that. And so that's a big perceptual problem. Actually, one reason I kind of know it is I used to watch David Bradford present this to audiences, and this is exactly what they say to him. I think the word coupon clippers may be a little bit dated, but the concept is still there. So that's a big perceptual problem that would impede choice of this tax. But a consumed income tax has its own perceptual problems. And again, we're talking purely perception here. Consumed income tax, we basically have super IRAs for everyone and dis-saving treated as income. It doesn't collect a tax from businesses. Once again, we're not talking about tax incidents. I realize Joel doesn't like the phrase collect tax from businesses, but businesses are not observed paying tax here. And again, so that's the perceptual problem of the other route. So they both have perceptual problems. And I'll return to this dilemma at the end, that either way you're kind of running into something that is, to the public mind, maybe bad. Well, I have a second scenario, and that's kind of a Republican-led stealth scenario, a la the 5 easy pieces stuff that's been talked about. When I called a stealth scenario, I also had a reader who said, why are you accusing them of stealth? Well, the fact is that people like Grover Norquist and others have written, and Charles Walker saying that stealth is the way to do it. So, anyway, what are the 5 easy pieces? The list varies, but usually it's reduced marginal rates, expensing, corporate integration, large or unlimited Roth IRAs to push the cost, budgetary cost back, and a territorial system for outbound investment. And I cross out the first because that has absolutely nothing to do with the choice of tax base. You can obviously have rates in any tax base, so it's not really part of, it might be part of their plan, but it's not really part of a system shift. I also note, by the way, that anyone who believes A is going to happen and beyond the very short term is smoking something. I certainly do agree with everything Larry said yesterday about the fiscal gap. Now, importantly, how would this be done? I assume it to be the handiwork of the kind of apparatchiks who have been running tax policy for the last few years. I don't think that this is something coming out of AEI or Cato. Now, it would importantly affect how it was done. It would be, I think, a closed-door lobbyist-run process. So, and that is important to my sense of how that would play out. Well, what's a third scenario, which I don't really discuss? My guess is that eventually we'll have a VAT in addition to the income tax. That my notion is somewhere in there's a budgetary crisis or the Social Security and Medicare are endangered, and it's kind of agreed, let's put on a VAT to keep Social Security and Medicare afloat. Again, this is not an advocacy, this is just a prediction, but I don't consider this to be within the scope of just adding another tax to so it's not really within the scope of what I'm asked to look at in this paper. I do rule out the Gratz proposal, which is the VAT plus an income tax, let's say $100,000 exemption, and I don't think it's going to happen. So I do worry. I'm being like the atheist in Catch-22. I reject Gratz's proposal because it's not going to happen when, by definition, I'm looking at things that I kind of think are not going to happen. But I also think the Gratz scenario doesn't really fit in well with the theme of this conference or with my assigned paper topic. It really doesn't, except for a little bit of hand-waving, it doesn't really simplify taxing business or high-income individuals. It's to take the low-income people off the rolls. And even as to that, he's kind of suggested that there are issues. What about equity as between people earning less than $100,000 who are off the income tax? Are they just going to pay a flat rate VAT? What about if you wanted different marginal rates in that realm? What if you had issues of children or households? So he said, the employers will handle that. Well, that kind of makes one question the low-end simplification a bit as well. If you just sort of outsource to the employers the job of doing what the tax returns do now. So I rule that out, recognizing that currently it's on the political radar screen maybe more than some of these other ideas. Well, what are some other things to consider when you're kind of spinning out these scenarios? One is the importance of the U.S. fiscal gap. The fact that we have this thing, suppose we had a revenue-neutral reform, we'd still have the fiscal gap there. This means that tax rates are likely to rise, and it raises suspicions that some promises won't be kept. Take a Roth IRA. We're not giving you a deduction now, but we promise, honest, it'll be tax-free when you withdraw it 20 years from now. Well, Congress in 2006, if it happened this year, might think so, but what will Congress in 2026 think? Big deficits and so forth. Not clear that a Roth IRA promise is credible, even if the current ones making the promise wanted to be credible. A point that's become increasingly well known, tax rate changes are a much bigger problem under typical consumption tax accounting than income tax accounting. Like under a Hague-Simons income tax, where you literally measure things every year, you wouldn't really have huge tax rate change problems. But in consumption tax, or in typical consumption tax accounting, you do. It's not inherent to being a consumption tax, but if you have expensing, you basically have the deductions in one year and the inclusions in another year, and that means rate changes have huge effects. So that's something to keep in mind about a progressive consumption tax. If it uses typical consumption tax accounting, the rate changes become a real problem. The second thing is that obviously interest group politics will shape any conceivable process of fundamental reform. We have a world where interest groups are very powerful, and it's not like, the people in this room are going to decide what to do and that'll be it. Interest groups are going to have to be part of the process. But one thing that does make a difference is whether they're running it or merely being bought off. And in '86, I would say that the proponents of the reform kind of had enough interest groups that were interested in it to begin with. I think it was like the service businesses that liked the rate cuts and didn't mind losing the ITC because they didn't have it. And then '86, they had to buy off a whole bunch of people, like the infamous rifle shot transition rules. But there's a difference between buying interest groups off, which will admittedly sully the process, the difference between that and when they're running the show. Anyway, what about 5 or 4 easy pieces? What's the simplification potential there? The fact that I envision it being kind of a lobbyist-led stealth process, not a Cato initiative or something, would certainly affect its execution. One thing I'd certainly suspect is that they wouldn't have addressed borrowing. This was the big problem, or a big problem, among others, in Nunn-Domenici, the 1995 consumption tax, progressive consumption tax proposal. Treating dis-saving as income. Now, something like a retail sales tax, of course, we do, in fact, tax consumption out of dis-saving, because if you go to the store, they don't say, oh, since this is out of borrowing, we're not going to charge you, obviously. So in that sense, you automatically tax dis-saving that's for consumption. But when you're doing it through individual returns, you might not. So if they're kind of just changing the current system, I suspect they wouldn't address this. A second point, if they go to corporate integration, a lot of us like corporate integration in principle, but I guess the sort of New York practitioner Ed Kleinbart has persuaded me that the economic benefits of corporate integration are seriously compromised if you retain the debt equity distinction, which I think a stealth process, just like exempting dividends, would do. We're coming to a world where New York practitioners basically say, what are the economics you want, and what do you want to call it, debt or equity? And those two are totally separate questions. You just staple them together, and you have your instrument. So essentially, you can use debt. What's the definition of debt? Debt is an instrument issued to a tax-indifferent party. Equity is an instrument issued to a taxable party. So that could make it there are enough tax-indifferent parties around that could make it a real problem to do corporate integration that way. Finally, territorial system. Well, I certainly, whether or not it's one's favorite system, which I don't know, it might be or it might not be, this sort of Grubert and Moody 2001, which was also reprised yesterday in the dividend exemption thing, I kind of like that rule, territoriality, but also better rules for taxing IP and things like that. So I would kind of like a territorial system that Harry here designed, but that's not necessarily the one we would get. I noted this week when I was about to come here, Tom Newbig has a piece in Tax Notes where he says that he explains why businesses don't actually like expensing as much as they like lower rates. But anyways, that's you kind of wonder maybe they'll get both. But I would assume expensing would be a big piece of that. And of course, with a big problem with expensing goes back to borrowing. You have kind of I kind of imagine 4 easy pieces as very possibly being kind of consumption tax on the inclusion side and income tax on the deduction side. And that's not really a good formula. Well, here, what's the likely base broadening under this proposal? Next slide. I don't think there would be any. The way I see the process, this would not really be an attempt to pay for what they're doing. So I think we can go on to the next slide. That brings us to now kind of a more credible, less frivolous process of bipartisan X-tax. And there are a whole bunch of choices that I discuss in the paper that would have to be made. And one is origin basis versus destination basis. I've become persuaded, and I discussed this a little bit in the paper, that David Weisbeck's written about this. It had no effect on me whatsoever that when I wrote the paper draft, I thought Weisbeck might be my commentator. But I think he has a good point. He argues that he's written a couple of things about how the flat tax or the X tax might or might not be gamed to death. He basically says you kind of need a closed system, which he defines as one where if I have a deduction and you have it, or a credit, then you have an inclusion. The counterparty has to be kind of symmetry between the two treatments, because then anything people gin up where they kind of, which you can't even imagine up front what it would be, it turns out to be a wash if you have taxpayers on both sides and if you can't deduct it if a taxpayer isn't including it. And that destination-based system can have that character of being a closed system. So I kind of think that's would probably, for that reason of tax planning opportunities, be the right way to do it, leaving aside all the other well-known, long-rehearsed destination basis versus origin basis issues. Now, politically, would they choose the destination basis? Well, it looks like it's an export subsidy. No, economists know it's not, but that might be politically helpful. On the other hand, it does create treaty problems. It's WTO things because this is considered a direct tax, and whereas a VAT is an indirect tax, it would potentially be a treaty violation to do it here. Now, one of the things that's funny about treaty objections is that if we switch to destination basis with no transition rules, we're kind of, since the U.S. is a net capital importer, we're kind of handing money to foreigners a little bit. So it's sort of amusing that some other foreigners would be objecting. Nonetheless, I suppose one would get that. I wonder, this is not in the paper at all, but it just occurred to me, in theory, you could imagine a one-time tax to prevent the transition gain. I know Alan Arabeck, for example, once wrote something about how, and I did too, about how if you adopted corporate integration, you could have a one-time tax on the windfall from people in the past. Politically, though, that would be pretty hard to do, I think, and I'm not quite sure how it would be designed either. Final point I'll make here is that in terms of the treaty problems, this is something that rightly drives economists crazy. There are some law professors who will say this is an absolute constraint, and as a political matter, they may be right. But what is the X tax? It's basically a VAT plus a wage subsidy thing. You can do VATs, and you don't have a treaty problem. You can do wage subsidies, you don't have a treaty problem. But if you put them together, all of a sudden, you're violating the rule against export subsidies for direct taxes. So one hopes that the sort of the ridiculousness of considering that a problem would mean it wouldn't be, but of course it's hard to really know in the world of international politics and law. Well, what are some other structural issues in creating an X tax through this sort of bipartisan reform process? I would certainly bet money, I'd go to point 8 at least, against loss refundability being allowed. VATs have loss refundability, but because this kind of looks more like an income tax, I would just kind of suspect that it would be unlikely to happen. Now, I personally think that loss refundability in a closed system makes a lot of sense, that it would be foolish to have non-refundability here. You'd also have, in VATs, companies sometimes have a net minus. Now they're deducting wages also. So this is an unfortunate feature I would guess would happen politically. And then people would then come up with wasteful transactions that are basically involving, for example, tax exempts or sale leasebacks or whatever it was under the structure of the system. They'd be trying to find ways to use the losses. and doing these silly transactions that would look a lot like tax shelter transactions today. Now, the thing is actually that since non-refundability is silly to begin with, one might wonder how hard to try to stop these things that do it by the back door. Nonetheless, one wouldn't be surprised to see some rules emerging against it. Another issue, there have always been small business exemptions that could conceivably be mischievous. You don't want the child's lemonade stand to have to register, but how high would that go politically in a political environment? I don't think it's been a huge problem under VATs in Europe, partly because they want to register for their own reasons relating to their outlays. But it could be a problem. On the other hand, today in the income tax, cash businesses are getting away with murder anyway, so if those are the guys we'd be losing, maybe it's not worse. A final point, or further point here, transition relief would not be a big surprise politically. Now, I'm more skeptical than some about how desirable the transition hit is, because you say, honest, we're just doing it once and once only, we'll never, ever, ever do it again. That's inherently, I can understand that the claim is, well, since you're switching systems, this is the only time you'll do it. Inherently, it's hard to, it's a tricky thing, because once you've done it once only, it makes sense to do it once only again. And note that rate changes do have the same effects all over again if you have an expensing system. So on the one hand, I would kind of expect transition relief, but then we have the kind of, if there's life on Earth, then all the conditions must be present. The transition hit might be important, whether it's actually lump sum or not. Again, I think it would be seen coming, and then it would be expected to recur possibly. But you kind of can't have the thing to begin with unless you have this, because it permits the rates to be lowered and so forth. So in the scenario where a bipartisan X-tax actually is enacted, I think it might be plausible to say that this unlikely event of a transition hit actually happens. Well, another question that arises is the accounting choice, income style versus consumption style accounting. And again, neither, you can kind of use income style accounting, I mean sort of capitalization allowing deductions later on. Consumption tax style accounting, I mean expensing. Now, as I've written about before, you can actually switch. You can run an income tax off consumption tax accounting by having expensing in the first year for the present value of all the deductions, and you can run a consumption tax off income tax accounting by giving interest on basis. But if you do use what I call consumption style accounting, because it's more commonly associated with it, you do get this big rate change problem. David Bradford was swayed by this enough to propose income tax accounting with interest on basis. I used to tell him, once everyone else in the world has become a consumption tax advocate, you're going to become the world's only income tax advocate, because he liked income tax accounting so much, and the Haig-Simons idea. But so he was going to allow interest on basis to prevent this problem. But this would certainly make it look more complicated. I think the optics would be bad. Would it actually make it be more complicated? Possibly it would. David would always point out that the penalty for getting it wrong here is less bad than under the existing income tax. If you fail to do the timing rules properly under an income tax, all you have here is problems when there are rate changes, whereas under an actual income tax, if you get things wrong, you create timing issues automatically. So I kind of find it hard to believe that this would happen. And then with rate increases expected, of course, we get all the intertemporal problems, both people switching between years and also simply the fact that there's an expected burden on saving because the tax rate is going to be higher in the future. So, by the way, it occurs to me as I stand here that I'm just saying, I think this political thing that would happen and this wouldn't happen. What's my evidence? Well, once again, we're in the world of the unknowable. I'm being asked to forecast what would happen if a consumption tax were enacted. So I'm not convinced that there's really much more I can do than say, this seems plausible to me, that doesn't. So with apologies for that kind of off the cuff type of prediction, I think that's kind of what the exercise the paper calls for. Now, the theoretical answer to consumption, to the rate change consumption style accounting is tax smoothing, by which I mean that in every year you incorporate all known information, you establish the rate that seems likely to work over the long run, and therefore you make the problem of rate changes symmetric. It's just a risk problem. Gee, rates might go up, might go down. The huge problem with the burden on future saving is everyone knows the risks are going to go up. So if the current tax rate uses all of the best available information about what rate is actually necessary, you'd avoid the bias. But anyone who thinks that's going to happen is probably mistaken. It seems unlikely that tax rates will be regularly updated based on the best available information. It seems more likely that they'll lag. Thus you get basically a burden on saving through what's called a consumption tax that uses expensing. Well, what about targeted tax benefits and really getting to the seamy side of the politics of this thing? Obviously, a home mortgage interest deduction has been just in just about everything, even Treasury 1, as was pointed out yesterday. So you'd certainly expect that to remain. One important thing when you have a consumption tax is that you have problems with arbitrage, with borrowing deductibly if you're allowed to, despite it being a consumption tax, and investing excludibly if it's an R style rather than R plus F style consumption tax. And this occurred to me that if you made this a home ownership credit, you'd still have the same distortions of home ownership, which I guess is what the political system wants, but you wouldn't be playing these arbitrage games. But I don't know if this would be feasible or not. Probably be hard to do. All these other issues would arise: charitable deduction, medical deductions, or health insurance exclusions. All these things, state and local income and property tax deductions. There are, for some of them at least, there are some arguments in favor. There's also very powerful political support for some of them. Again, an example in '86, they had to back off on the state and local income tax deductions, except for putting in the AMT, which no one thought would get that serious. A particularly silly rule that was in the USA tax is a double exclusion from municipal bond interest to retain its advantageousness versus other interest. Now, funny thing about this, by the way, is that corporate interest, bonds issued by a corporation, they might well be deducting the interest and it's going to a tax indifferent party, so that it's kind of, they're losing that. So even if there are some interesting issues I have a little fun with in the paper about how to think about this problem if you actually wanted to retain the relative advantage of municipal bond interest. But I just note here, state and local governments are powerful. Their interests here, it's very possible that some extra benefit beyond an exclusion that was now shared with everything else would have to be provided here. Another thing you might expect to see, and it was in the tax reform panel, tax benefits for education. One thing I note here, and even if you have this miraculous bipartisan X-tax being passed, there's no reason to expect politics to fundamentally change. One of the ludicrous things about the treatment of education in the tax law today, and many other things, is that you have multiple tax benefits that are overlapping. The basic reason being, if you're a politician, it's much more fun to propose a new benefit that might even bear your name than it is to, expand an old one. No reason for that to change. So for education or anything else, if they have one tax benefit, why not 5? And I would kind of expect that to be the natural process of politics. Again, '86 kind of fell apart due to politics. It's not clear how much better this would do, although that's one of my next topics here. Well, what about interest group politics? It's not hard to start listing industries that seem likely to be bought off, to have to be bought off. Farmers, the energy industry. Everyone knows how powerful these groups are. And a winning coalition would require other members. Then I list, real estate, defense contractors, shippers, Iowa ethanol industry, and people who followed the tax legislation of the last year or two will recognize tackle box makers and bow and arrow manufacturers. So maybe we'll have an X-tax with special treatment for bow and arrow manufacturers. Another thing is you can't just buy off a few groups. You have to have some basic supporters. So I don't know, it was the service industries in '86. Maybe this time it would be the capital-intensive industries that are getting the expensing. Although again, there's the point that they don't care that much about expensing, but you kind of have to find some supporters to do this. So at least in their case, it wouldn't mess things up too much. But you are going to have to buy a lot of extra groups. Well, this brings me to the political optics of expensing, and here's one of the things which I've rethought in writing this paper. I like to think that, one nice thing about expensing, even apart from it being consumption tax, is that it kind of makes it easy to be neutral. It's kind of very prominent. Obviously, Haig-Simon's income tax or an income tax economic depreciation can be neutral between assets, but that's kind of harder to do. Expensing, everyone expenses, and it achieves the neutrality. That makes it optically and politically easier to have inter-asset neutrality. Isn't that true? Well, I'm not so sure the more I think about it. Obviously, if everyone did have expensing, that would be nice, but think of all the special things you can do. Partial credits, just think of the ITC, investment tax credits. Special rates, as VATs in Europe have. You get special deductions, like these guys get to deduct interest. More than 100% cost recovery, which is what percentage depletion. I guess I got to watch myself here down in Houston, but percentage depletion, though obviously not widespread as it once was, provides greater than 100% cost recovery. So there's a lot you can do. If you're a politician looking to offer a basic expensing system to favor some industries, it can still be done. So I find it hard to have an enormous amount of confidence about that. Another topic that's come up very extensively in the literature is the financial services industry. If you're basically have an R base instead of an R plus F base, I'm assuming here that I can use this small talk, this jargon with this audience. You have the problem, of course, with financial service businesses that embed their fees in interest rate spreads. Obviously, we have a problem in the income tax of this sort today because when you get free checking and your checking account pays too little interest, it's a version of the same thing. But ignoring all F-denominated returns would make the problem bigger and more prominent. The tax reform panel recognized this, and they recognized they didn't have the time or anything else to try to fix it. It's a pretty bad problem, of course, and one of the things that makes it worse, it's not just how to tax Chase Manhattan or something, or whatever they're called, Chase, whatever they're called now, but you have, well, leaving aside that we don't really have to worry about GMAC or GM anymore, you have all kinds of businesses with financial wings, so you got kind of transfer pricing type issues. It can be very messy. The tax reform panel had kind of a placeholder fix to that I'm sure they recognized was really just the starting point for thinking about it. Obviously, this would be another problem. Then, of course, the financial services industry is also politically influential, so that makes it worse. Another issue to think about here is what would happen to public assistance programs? You have all these things that kind of run off income or assets, TANF, food stamps, Medicaid, etc. The kind of logical approach, if you're doing an X-tax, is to base it on X-tax wages. But it's not clear this would be feasible politically. You know, in a sense, think of Melinda Gates, in effect, getting food stamps if she's not working. And you could also ask about whether it's desirable for these people with resources. But this raises an interesting question. If you like a consumption tax in general, why would you feel, if you would, less comfortable that it's the way to address the neediest people? Why would you not want to give welfare benefits to someone who has resources but no current wages if you're otherwise willing to base your tax system on that? And one thing I would note, there is a bit of a difference. What makes the consumption tax idea so powerful is the idea of lifetime income and lifetime consumption smoothing. And that's probably least applicable to people who are poor either lifetime, they may have a hard time smoothing or be bad at it, and also people who are poor in a given period may by definition have failed to smooth. So the basic reasoning that makes a consumption tax to some of us more compelling intellectually than income tax has least purchase perhaps in this area. So even though the issues are logically consistent, it would become a problem. Do you do that, and what does that do to simplification on the low end? Okay, back to the coupon clippers problem. Again, the X-tax supposedly exempts coupon clippers, and I take this perception to be based not on the fact that it's a VAT in part, but on the fact that there's a wage tax which only wage earners are paying. Well, of course, that's a very silly way to look at it, because having wages deducted and included instead of having a straight VAT is purely a wage subsidy. It's a way to deliver instead of a demo grant, a benefit of up to the amount of the lower brackets. So in fact, workers are better off being, quote, taxed under this, given the employer side deduction. So the result is that, in fact, coupon clippers presumably do worse under the X-tax under the VAT, but they seem to do better because you observe this wage tax being paid by the employees, and if you ignore the fact that there's also deduction on the employer side, it looks like these guys are being treated worse than the coupon clippers. And I would take that seriously as a perceptual problem, although it's derisory as a problem to take seriously. So it might look like they're getting away with something. Obviously, I don't find it enormously encouraging that the 2005 tax reform panel felt compelled by some of their members to propose an add-on individual level tax on investment income. That would not be a huge success from the standpoint of simplification. There are all kinds of complexities that would have emerged out of that, for example, especially when you had people with IRAs that they were giving, that they had to play games between the IRAs and this 15% tax. So it's certainly discouraging that that happened. It may tell you something about the politics. Finally, this brings us full circle to the political feasibility problems of the consumption tax. In the academic world, I think the big concern is that you don't observe current period tax revenues being collected from holders of unconsumed wealth. And it's all very well for a consumption tax advocate to say, well, it's basically at the time of enactment, the tax has been hit, and if it's a constant rate tax that'll be on forever, they've already paid it. It's just by deferring consumption, they're not reducing the burden of the tax at all. That's not good enough for some people, and they would continue. But that's one problem that's just a given when you're passing consumption tax. But I think that there are more problems with it politically. And again, you have the X-tax exempting coupon clippers and the people who get interest in dividends, capital gains. You have the consumed income tax exempting businesses. And again, to make it clear, I'm speaking about perceptions, not about the economic realities of these taxes. And so if you kind of think, well, gee, we can't do either. We have to tax the business level, and we have to tax the receivers of the owners of financial interests in business, we kind of have to tax them both because people think they're getting away with something. If neither of those can be done, then the consumption tax isn't the only thing that you can't enact. Also, obviously, corporate integration becomes pretty problematic politically. So on that heartening note, I will close.
Okay, thanks, Dan. Our first discussant is James Elm. James is the professor and chair at the Andrew Young School of Policy Studies, Georgia State, also editor of Public Finance Review.
Thank you, George. Thank you, John. This is a terrific conference. I always like coming to conferences. I always learn a lot. I learned a lot, especially from Dan's paper. Depressing in lots of sober paper, a depressing paper in a lot of ways. And it's somewhat outside of my depth. I mean, we're talking about the likely politics of tax reform, and you know, most of us in this room are, maybe all of us are economists, and so when we're starting to talk about the politics of things, we're getting a little bit outside our area of expertise. But I found this a terrific paper. Down there we go. No. Oh. Only if you want to see.
Yeah, no, I do.
In some sense, this is an easy paper to discuss, in that virtually everything in it is unknown and unknowable, as Dan has talked about. The politics, the likely ways in which the politics will evolve, is not something that any of us really know here. On the other hand, it's a really hard paper to discuss, as I indicated, because it is asking us to move into the realm of politics as opposed to economics. My characterization of this is the main issues are pretty straightforward, as Dan has said. How would the political pressure points affect the specifics of any consumption tax reform, especially the simplification that all, the people who are advocating consumption tax reform believe is one of its main selling points? More specifically, are there particular political scenarios that would be most likely to lead to consumption taxation? And under those scenarios, what types of consumption taxes would emerge? And what types of political interest would have to be accommodated in order to, in the course of that consumption tax reform? Well, again, this is a pretty speculative endeavor, only, as Dan put it, for the bold of heart. Because, again, the answers to these questions are fundamentally unknown and unknowable right now. It's also, I think, a really fascinating endeavor, and I learned a lot from reading Dan's paper. But ultimately, as I said, I found this a very sobering and, I have to say, depressing discussion in a lot of ways, because the end result, the end conclusions are several. I mean, Dan is very clear in saying, right from the very start, that he doesn't think it's very likely that the political circumstances will emerge that will allow any type of consumption tax reform, let alone any type of comprehensive reform, let alone a consumption tax reform. Even so, he suggests a couple plausible scenarios. A bipartisan process, a la the Tax Reform Act of 1986, when the perfect storm occurred, or as Henry Aaron was talking earlier today, the dead cat syndrome led people to say, I don't want this dead cat to end up on my desk, on my doorfront, so that I am responsible for killing the tax reform. And he thought that this would lead to, under these circumstances, the adoption of a progressive consumption tax, the X tax. Another scenario was the Republican-led process that pushes through Congress with the very tight political control, something along the lines of the the four easy pieces. But then here's the main conclusion here, and I think this is where the bulk of his discussion in the paper, which it points to, is that even if this perfect storm of events occurred, even if this dead cat syndrome reemerged one more time, the reform that would emerge from this process, from this political process, would not achieve fundamentally the simplification goals that the advocates of consumption taxation believe are the main advantages of consumption reform, and presumably would be possible under a pure consumption tax reform. The specific reform options and issues are very many. The politics of the process would hijack the process, and the likely result, here's the sobering and depressing conclusion, is that we'd end up with a complex and a distorting and an unfair tax, even though the starting point for and the rationale for reform is that we think things are complicated and distorting and unfair. And what would we end up with? Something that would replace this that wouldn't be any better. Now, again, I think this is a speculative process. We don't really know what's going to happen. Unknowable, I think, what's happened. But I think Dan lays out the issues. The main political interests here that he talks about in some depth in the paper, I think, are the plausible ones. Home ownership issues, charities, state and local governments, pension systems, financial service businesses, health insurance, education, oil, gas company, the role of necessities. The main issues that he looks at also, I think, are very comprehensive. The fiscal gap, the issues about expensing, corporate integration, how IRAs would be treated, origin versus destination basis of taxation, especially in the tax reform, the consumption tax reforms. How would capital gains be treated? Small business exemptions and X-tax, transition issues, lost non-refundability, accounting choice, targeted tax benefits. All these, I think, are the crucial ones, and it's a fascinating discussion in the paper. So all in all, I think that the reform options that Dan comes up with are plausible. Let me raise a couple questions in the context of our discussion yesterday. What about the fair tax? Larry suggested that the possibility of adoption was 0.8. In the interest of full disclosure, I want to highlight my Georgia connection to the fair tax debate. The book, The Fair Tax, was written by Representative John Linder of Georgia, and also by released in Atlanta, a famous talk show host, Neil Bortz, radio talk show host, on 750 on your radio dial in Atlanta if you want to listen to him. He plugs this book quite a lot. What about the flat tax? Dan dismisses that. I think that's probably right. On the other hand, there are lots of examples in Europe, especially in transition countries, where the flat tax revolution is a dominant one. Many countries, especially, again, the transition countries, have adopted a version of the flat tax. Actually, it's not quite accurate. They've adopted a proportional tax, usually at a fairly low rate. Ukraine, for example, where I've done some work recently, 13% marginal tax rate. It's not on a consumption base, but it's billed as a flat tax. A lot of other countries are doing the same thing. If it happened there, can it happen here? What about the value-added tax, or the Michael Gratz combination of the VAT with a high level of exemption? The dominant reform in countries around the world in taxation, in tax reform, has been the adoption of a value-added tax. Why not here? What about other political interests like high-tech industries or other services, or the elderly, or the unions, or in particular, I put that up not with the last one, not with the intent to be particularly serious, but what about economists as a pressure group here? Will the political process bow to our wishes in the whole scenario? Probably not. Probably not. Even so, I think the scenarios are certainly plausible and justified and very well reasoned. Fascinating discussion again. But given that Dan felt that he had the right to make these bold of heart predictions, let me make my own bold of heart speculations. And my own bold of heart speculations are I think, several. I think the chances of any comprehensive reform, let alone consumption tax, but any reform, I think right now, in the United States are very remote. And I think the reasons are pretty straightforward. I don't think we have the perfect storm of the dead cat syndrome of events these days that we had in 1986. I think, first of all, in 1986, although consumption taxation was obviously on the agenda following the blueprints, for example, and earlier in the 1980s, for the first time, the publication, I think for the first time in the Wall Street Journal editorial by Hall and Rabushka about the flat tax. So that was out there. But I think for the most part, the discussion in Washington and among economists and policymakers was all in terms of we're keeping the income tax and how can we make this a little bit better tax. And so I think the consensus at that time was on cutting rates and expanding bases, but keeping the base the income tax. At the present time, I think there are lots of competing proposals, and even within this august body here, I don't see any particular consensus on the particular form of taxation. I think it was suggested yesterday that most people here would be advocates of consumption reform, consumption-based reform. I'm not sure that's true. I could ask Henry to talk about that. My guess is that he would enlighten us on that as well. Unlike 1986, when the obvious selling points were get rid of the tax shelters and lower marginal tax rates, I don't really see any obvious and easy selling points. Simplification, I think, is a selling point. How far will that go? Unlike 1986, I don't think we have a president right now who's able to generate the political support for reform. Unlike 1986, when there were politicians who were willing to work with others, I don't really see that right now. Even there was a recent editorial or op-ed piece in the Washington Post about Ted Kennedy, saying that Ted Kennedy is the favorite fundraiser for Republicans. On the other hand, Kennedy is still an old-style politician in that he tries to do some deals. He tries to work with people. Think of the No Child Left Behind Act, for example. And in response of his colleagues, many of his Democratic colleagues believe that he is a dinosaur and he's completely out of touch, and he is foolish for making those kinds of deals. There aren't many people like a Kennedy who are willing to do that horse trading these days. And unlike 1986, and this is a point that's made by Roseanne in a recent National Tax Journal article, and I think Jim and Roseanne could talk about this. The constraints imposed on any current reform process are likely to be far more severe and politically difficult to deal with in terms of things like revenue neutrality and distribution of neutrality, items that are off the table before any discussion, the requirement that the deliberations be open. I'm not sure if that was a big constraint, but again, Jim and Roseanne can talk about that. So I'm pessimistic about this. Having said that, I have done a lot of work on tax reform in other countries around the world, and so my final comments here, not necessarily too brief, but fairly brief, John, relate to those experiences. Are there lessons from other countries, especially developing countries, where comprehensive reforms have occurred over the last 25 years? And in particular, are there particular conditions, economic and political, under which reforms seem to be more likely in those countries that might be relevant for the U.S. experience? And what forms of tax reform may emerge under those conditions? So let me start with that first issue. What are the conditions, political and economic, under which tax reform is more likely? Well, I think in almost all countries where these reforms have occurred, whether it's Jamaica or Indonesia, and I wish Malcolm were still here, because Malcolm led a tax reform effort in Indonesia, I think that was quite successful, or in Russia, where I and my colleagues have worked, or in the Philippines, or in Colombia. I'm not sure what's happened with our excellent proposals in Colombia, Jim. Or in other countries. I think the preconditions for some kind of reform are that the tax system is seen as very complex, excessively and unnecessarily complex. Over time, many tax systems have been amended to raise revenue, or to respond to wishes of some particular constituency for more favorable treatment, or to promote specific activities, or to protect the poor, or there might be great rationales for these changes, but what they lead to, what they have the potential to lead to, is complicating of the system, which leads to higher administrative costs and more arbitrary administration, decreasing confidence in the fairness of the tax system. There are large distortions in behavior that result. In many cases, these are the taxes introduce a wide range of distortions in individual and firm behavior. What's especially common in many of these countries is the use of special tax incentives for targeted investments. Many of the countries say, we have to have these incentives in order to compete with our neighbors and in order to encourage growth. And these are often given on a very discretionary basis, very complicated, very disparate treatment of different types of taxpayers, and they introduce enormous distortions. There are large horizontal and vertical inequities in taxation. there are many sources of horizontal inequities in developing countries' tax systems. I think probably the one that's the most obvious and the most contentious in many of these countries, especially in developing countries, I'm not saying this is in the United States, is that between workers who are subject to formal income tax withholding in the employer sector and those who are working in the self-employed sector, the informal sector, and are largely untaxed. But there are lots of other areas of inequities. Some taxpayers receive non-taxable allowances, others fringe benefits, others don't receive those fringe benefits or receive them at a lower rate. They face very different forms of effective rates of excise taxation given the uneven pattern of exemptions on the excises. The corporate income tax discriminates wildly across different firms. Lots of horizontal and vertical inequities. Well, does this sound familiar? Does this sound familiar? These are the kinds of issues that have motivated, I think, the tax reform discussion in the United States. There are lots of other ones. Narrow and shrinking tax base. I think the crucial one probably here, crucial ones, are the limitations in tax administration. But the other one is that the tax system that currently was in place in many of these countries is one that was designed for a world that's no longer around. It's outdated and it's emerged in an ad hoc way. And so, I think these are kind of the necessary preconditions. In other words, the tax system has to be seen as broken. As broken by most of the relevant players. There needs to be some kind of consensus on how to fix this. There needs to be a plan, if you will. There needs to be a strong champion who can generate the political support for reform. And I'm not saying this applies to the United States, but because I don't think the World Bank is going to step in and help get us out of our fiscal debt situation. USAID probably won't do it either. But there oftentimes needs to be an external party who can help finance the reform. And given that, most all reforms around the world in the last 25 years have attempted to expand the basis of all the various taxes, but especially the income tax. And by doing so, that allows marginal tax rates to be reduced. In many cases, a value-added tax has been reduced. The United States is the only one of most of the major countries around the world these days who does not have a value-added tax. I had some other lessons from tax reform, but I think let's quit at this point.
Next discussant will be George Mann. George is the Howard Smith Professor at the University of Virginia Law School, also recently stepped down as Chief of Staff at JCT.
Thank you, George. It's a pleasure to join all of you. I too have learned a lot from this conference, and I really appreciate the opportunity. In his paper, Dan Shaviro feeds the various consumption tax reform proposals into the political meat grinder that we know is the legislative process. As he indicated at the invitation of the conference sponsors, he speculates about the effect likely political compromises will have on the tax reform end product. His paper, I think, adds an important new layer of analysis to some existing good work, describing the difficult structural and administrative issues that certain consumption tax reform proposals will have to confront. I'm reminded about the importance of this examination from this morning's paper, where I noted that in an illustration of the top that syndrome in Congress, the Senate Republicans are may be proposing a $100 per person rebate in lieu of the Senate Democratic proposal, which apparently is likely to be a suspension of the gasoline tax. In addition, I might note that just since we did talk yesterday about the retail sales tax, my eye also was caught by another smaller story that the Florida legislature did not just propose but actually passed yesterday, a sales tax holiday for certain expenditures for people in anticipation of the upcoming hurricane season. Dan is a very smart analyst, and not just of law and economics, but also of politics and the legislative process. And I really have very little to add to his many sharp and cogent observations and predictions. Like Dan, however, I don't think either one of his two main scenarios is that realistic from a political standpoint. And so with the indulgence of the conference sponsors and the rest of you, I thought I would just put my political glasses on for a few minutes and consider a broader set of policy options. I caution you, as did Jim and Dan, that my discussion is clearly in the realm of the unknown, if not also the unknowable. When I put my political lens on, I simply cannot get out of my view the 600-pound or the 800-pound gorilla. And I am referring, of course, to what both Larry Kotlikoff and Jim Baker and others mentioned yesterday, which is the budgetary situation. It's obviously not in my area of comparative advantage with this group to speak to you in numbers, and so I won't. But I think that we can all agree that for the foreseeable future, which by definition is about as far as this observer can see, the nation's domestic agenda will be dominated by concerns about the fiscal gap and the deficit. Like others, I think of the upcoming period as a time of fiscal calamity. Dan mentions in his paper that a week is a long time in politics. Well, our current budget reality demonstrates to me how 5 years is an eternity. 5 years ago, many people had thoughts about tax reform, Social Security reform, health care reform, tax simplification, even paying off the national debt. Not any longer. It seems to me that if any of these reforms can even be attempted now, the reform will surely be colored by our new budget reality. In contrast to the mid-'80s, when, as we know, President Reagan successfully pushed through a revenue-neutral tax reform proposal in the face of large budget deficits, we are now, of course, 20 years closer to the liabilities associated with the baby boomers, with that situation, of course, having been made worse by recent legislation. In addition, we now face a similar challenge on the tax front. If one thinks of the expiring tax cuts and AMT patch and all the rest as in the nature of promises or liabilities incurred by the current Congress, but to be paid for in the future. Thus, I'm not at all sure that we can seriously think about a revenue-neutral tax reform any longer. So let's assume that after taking whatever steps it can on the spending side, including entitlements, and using far too many budget and scoring gimmicks, Congress still finds itself in a budget pickle, as surely it will. What can we expect Congress to do on the tax side and with tax reform? Well, for one thing, it's not going to look at the consumption tax proposal known as 5 easy pieces that Dan went through. Dan imagines the possibility that that proposal would arise from a stealth effort supported only by Republicans, analogous to Republican-led tax efforts between 2001 and 2004. But of course, tax reform is different from tax cut legislation. Perhaps the single most defining characteristic of tax reform is that it rubs many special interests the wrong way. The failure of Social Security reform demonstrates the inability of one party to accomplish this on its own. More importantly, as Dan's analysis shows, 5 easy pieces doesn't work. There are far too many loopholes. It would never be considered by a budget-conscious Congress. Now let us leave on the table for now Dan's other option, which is essentially a Bradford X tax, and add a few more. One would be enactment, and this was mentioned by Dan and by Jim, one would be enactment of a value-added tax, not, as some have suggested, as a replacement for part of the income tax or the payroll tax, but rather as a supplement to both. Another option would be the current income tax system, but with higher rates. A third would be leaving the minimum tax unindexed and letting it gradually subsume the regular income tax. And a final option would be a broadening of the current income tax base in an effort to minimize the amount tax rates would have to be raised. Let's speculate a little bit about which of these options is likely to be favored by liberal and conservative elites, and also by everyone else. Well, for liberal elites, I would hope that the VAT, or I would think that the VAT, the minimum tax, and the X tax would all be rejected out of hand. Of the remaining choices, I would hope that liberal elites would prefer a broadening of the income tax base to higher income tax rates. The Wyden-Emanuel bill, which seems to be about the only liberal version of tax reform in existence right now, modestly expands the income tax base while capping income tax rates at 35%. It's not clear what further changes would be made to that bill if it had to be revenue neutral or indeed revenue positive in our new budget-conscious world. Conservative elites would probably immediately reject the VAT, the minimum tax, and the option of the current income tax system, but with higher rates. One might naturally think that they would prefer the X tax to the broader income tax base option, but maybe not. A key question, it seems to me, is what type of rate structure would be included in the X tax. Now, you know that the tax reform panel presented a modified X tax option with a top rate of 30%. But we all know that there are several problems with that estimate. First, it assumes a base which, in Dan's judgment and in mine, is probably considerably more comprehensive than we are likely to see enacted. Second, it includes this odd appendage of a 15% tax on capital income. Although this addition doesn't belong in an X tax and would complicate it, it does help to lower the required business and household tax rates for the X tax and also offsets some of the pressure to make the X tax rate structure more progressive. Thus, if the appendage were cut out to make the X tax coherent, the tax system would probably have to have higher and more progressive rates than was projected by the panel. Third, the panel proposal is revenue neutral only relative to President Bush's world of permanent tax cuts and other new savings incentives. Relative to the real world, where reform must include some revenue above and beyond that provided by current law, rates clearly would have to be higher still. It might be helpful to compare tax rates under an X tax and an income tax, assuming an equally comprehensive taxation of consumption under each. Because the X tax would defer the taxation of income until the time of consumption, the resulting loss of tax revenue in the budget window would seem to force the X tax to have higher rates. This effect, of course, would be offset to the extent old capital is taxed again under the X tax, but not under an income tax. My guess is that for both empirical and political reasons, the offset would not be enough to cancel out the deferral effect, in which case the X tax will have to have higher, perhaps significantly higher, rates than the income tax. For the same reason, concerns about distributional fairness would cause the X tax to have a more steeply progressive rate structure than the income tax. The analysis of these issues, of course, might change if Congress were to focus on the fiscal gap rather than the short-term deficit and consider a lifetime perspective rather than an annual or 10-year one. But I am skeptical that Congress will do that, setting aside the feasibility of actually doing so. So the basic choice, it seems to me, for conservative elites may be an income tax versus an X tax with maybe significantly higher and more progressive rates than the income tax. Add to this comparison the further likelihood, for the reasons that Dan went through, that the X tax will not be pure, but will probably include some continued explicit taxation of capital income. And I would think the choice becomes fairly close. Finally, Dan points out that even a pure X tax without any explicit taxation of capital will still distort the savings decision if tax rates increase in the future, as seems likely in our budget-conscious world. What would be the preference of everyone else? Well, we might hope that if the liberal and conservative elites could reach consensus, they would lead everyone else to the optimal choice. In my view, this is to some extent what happened in 1986, where most of the public was for the most part disinterested in or explicitly resistant to any major change. Barring a repeat of that Pollyannish scenario, the American people might opt for the current income tax system, but with higher tax rates. After all, asking them to accept, and maybe more to the point, asking our leaders to convince them of, important changes to the tax base, which necessarily is going to create winners and losers, plus an overall tax increase, may be simply too much to expect. Finally, what is the most likely outcome? Well, if, as seems likely, all of these choices are considered in an extremely contentious environment where the possibility of political stalemate is very high, the most likely outcome may be the minimum tax scenario, because it would be the default. To me, this would be perhaps the most unfortunate outcome of all, because of first, the minimum tax's lack of indexing, which means that we would be back to the bad old days of automatic stealth tax increases. Second, its distortive and unfair distinctions between married and single people, large and small families, high tax and low tax states. Third, its disproportionately adverse effect on the middle class. Fourth, its high compliance costs in forcing an increasing number of taxpayers to perform dual calculations for some number of years. And fifth, the complete absence of any meaningful reform to simplify the law and improve its efficiency. My takeaway from this possibility is twofold. First, the good news may be that if that scenario plays out, we might finally have a tax system that is sufficiently bad enough as to trigger real tax reform in the future, in the longer-term future. And second, it does heighten to me the importance of reformers of all stripes trying to cooperate and reach consensus, because it does seem to me that that is a possible vehicle to avoid this worst-case scenario. Thank you all very much.
Thank you, George. Welcome to the floor to questions now. Alan.
So if we take off from George's last point, that the most likely thing may be what's in law now, because that doesn't require any action. And if we imagine that we get to a point where taxpayers, a majority of taxpayers, or all taxpayers, are subject to the minimum tax, why wouldn't that then lead to a situation in which people begin messing around with the minimum tax the way they've been messing around with the primary tax? That is, it seems to me that the only reason why the minimum tax has not had considerable efforts made to narrow its base is because until the last few years there were relatively few taxpayers subject to it.
Actually, there were some narrowings of the base. It went, yeah, for depreciation from an income tax norm, they took some stuff out of it.
But I'm suggesting even more that, for example, if we went to the minimum tax, more taxpayers are on the minimum tax, then we would begin to see a deduction for state and local taxes. We would begin
personal exemptions, which is a very good start,
and some of the things you suggested to make it perhaps the tax system fairer.
You know, the interesting thing, Alan, is that I was actually surprised, or I have been surprised, at how unbroad, if you will, the minimum tax is. That is, you know, aside from a few biggies, which we are all familiar with, the state, local, personal exemptions, and so forth, it really makes very small changes in terms of broadening the base. We like to think of the minimum tax, or at least it was designed at one time, as a very broad system with kind of a flat rate and just kind of a backup tax to the income tax system. But the reality is that is just not at all like what we have. So we would end up with this system that is, you know, I think just a terrible base. That is, it's not more comprehensively broader than an income tax, at least in a kind of reformer sense. But it has a few items that are totally nonsensical. that create then distortions across people for no valid reason. And so I don't really, but I certainly agree with you that there's no reason why it wouldn't get worse.
Tom? I think Dan made an important point in terms of looking at the connection of the tax system with the expenditure system. And I think a lot of the discussion of tax reform oftentimes is way too narrowly focused just on the tax system, as opposed to putting the tax system as part of the whole government approach to societal problems. And so if we don't have a pure base because we're doing things for charity or for home ownership, I'm not sure that troubles me that much. I guess in terms of the bipartisan approach to tax reform, one of the things I see as a difference between 1986 and today is 1986 was preceded by bipartisan revenue raising to close a big fiscal gap in both 1982 and 1984, where Congress had already, and the President had already accepted the need to expand the base. And I think that was an important precursor to bipartisan base broadening and lowering the marginal rate.
Could I just interject at this point? The major difference, I think, in 1986 was that President Reagan initiated the tax reform process for explicitly political reasons to blunt the appeal of a bill put forward by Bradley and Gephardt from the Democratic side, which seemed to be gaining some traction. So what he did was appoint a commission, instruct them to report on the issue right after the election, which the Treasury dutifully did, and then a process began where Treasury 2 emerged, and everybody kept bucking it along, and it eventually became legislation. But the bipartisanship was was cooked in the deal from the very beginning because of the way the process got underway.
Larry?
Yeah, I'm just wondering whether the fact that we have this fiscal gap might actually lead to something more fundamental in terms of might actually make it easier to enact tax reform, because when people start to see how much we're short of revenue, there's going to be a lot of pressure to collect revenue, and then you think, can you really get it out of this, machinery that's got so many problems with it? And there might just be that's where I see the hope for the fair tax coming, that people say, well, let's just have the broadest possible base, and let's tax everything in as low a rate as we can get, and let's have some basic rebate to protect the poor. Don't you see that as a political target?
Well, we're in the
That much time on the fair tax.
We're in the realm of speculation, but I'd say I see the add-on VAT as more of a way that would go. Oh, let's add a VAT. Now, I think I didn't spend more time in the fair tax because I didn't think politically it had that strong a chance, and certainly I didn't think that despite arguments in the merits you might advance, I didn't think the Democrats are likely to endorse it. I'm probably going to talk about it a little more revised, although probably to say I don't think it'll happen.
Jim?
Yeah, two things. One on the fiscal imperative of the long-term fiscal problem. I think while the audience in this room knows a lot about the long-term forecast, and many people here I think play a absolutely salutary role in educating the world about these issues, as long as long-term interest rates are low, and as long as there isn't a sense that there's a crisis mentality in the world, I think it's going to be very hard to get concerns about the long-term fiscal situation to catalyze action on immediate tax reform, because I think there is this other view that we will either grow our way out of this or that these are just not big issues. And if for whatever reason the world's capital markets are willing to continue to lend to the U.S. and to let us get by with very low interest rates, I think there's going to be a tendency in the political process to just postpone taking action on all this. And we can come back next week for another conference and try to talk about how we're going to get from where we are now to what will happen in 2030 and whether there'll be a crisis moment at some point. But I think once we start to speculate on how we go forward, figuring out or thinking about the scenarios by which the market decides that these are real concerns is a very important part of thinking through that scenario. The second thing, just to link up the commentary in Dan's paper about the various constituencies here with one of the points that I think it was Kevin Hassett yesterday made about the growing importance of intangibles and the shift away from the traditional bricks and mortar and equipment investment in terms of the capital stock. One of the issues that I think emerges when we think about traditional X-tax types of issues and the move to expensing and issues like that, those are primarily policies which emerge from a historical focus on long-lived physical assets and an interest in trying to simplify the tax treatment of those kinds of assets. Yet, if you are moving toward an economy which increasingly relies on intellectual capital and R&D and other things which are all expensed at the moment, the constituency for let's fix the problems with depreciation and things like that shrinks over time. And certainly a sort of bit of a concern that I heard as the tax panel was doing its thing was, aren't you basically trying to sort of move us to aren't you trying to help the old economy and relatively disadvantaging the new economy because the new economy already gets expensing on everything it's doing. And what are you guys up to here? So I think that's a real issue that in some sense plays out as part of the political economy in some ways.
Yeah, when Jim said in his comments, mentioned high tech, that was my thought, yeah, that is important. I had the same thought you do, that they don't need it, they were already there. So,
Okay, Jane?
First of all, I think there's a little problem in looking at the Tax Reform Act of 1986 as any kind of precedent for the kind of changes that we're talking about. I mean, if you actually look at that act, there were lots of changes on the business side, but the changes on the individual side were actually pretty minimal. We kept every itemized deduction except sales tax, kept all the fringe benefit treatment. We introduced some passive loss restrictions that affected only a minority of taxpayers. We taxed capital gains and fully ended IRAs, but the vast structure of our preference system, even in that momentous tax reform, stayed in place. So to move, we are talking about a far more radical, if you don't mind me using the word, move than we have ever considered in our history. And a lot of people consider 86 kind of a miracle in itself. The other thing is that, to me, one of the big barriers to the X-tax or any kind of flat tax proposal, I think it's the only feasible consumption tax because it doesn't have this big macro transition problem. Because you're collecting income from the same people, you're not going to have this huge price increase or a huge rollback in wages. But the consequences of no price increase is that this lump sum hit on capital is going to be all concentrated on equity capital, because the debt holders are going to be held constant, which means you have lots of opportunities, if you don't have transition, for essentially confiscation of assets. Think of somebody who's got a big building to sell, and it's heavily debt financed, doesn't get any depreciation, doesn't get any credit for repaying the debt, has to pay a whole tax on the entire sale of the building, even though its equity interest may be very small. Or think of retailers about to go out of business. His inventory, which he's never deducted, is going to be subject to full tax, and he's still got to pay back his loan. I think once people start understanding that the flat tax is, for example, a capital gains tax with no basis, I think that any kind of support for it is just going to melt away at that point. So,
Jay, let me just modify one thing you said, which is that the interest rate should go up, so the value of the debt should decline.
Well, but people have debt that's at fixed interest rate.
Well, the market value of it should decline.
Right. That's
what I mean.
Because of interest rates.
Yeah, because it's fixed coupon payment,
but the people who owe a fixed amount of principal who need to sell an asset and pay it back are going to have to pay it back.
Why is the interest rate going to go up if it's no longer deductible? Before tax interest rates go up? Pre-tax.
I think those are all interesting things to consider, but I still think you've got a situation where if you want to sell an asset and pay off your debt, you're just
Yeah, no, I mean, I started on the paper saying, well, there's got to be transition relief because of this. And I said, well, if the thing happens, you kind of have to assume that somehow or other this became feasible. But I agree with you, it's kind of...
transition relief.
Yeah, absolutely, yeah.
Increases the cost.
Yeah.
So.
And the simplest way, which would be like kind of a one-time deduction of basis at the appropriate tax rate, is probably unlikely to be part of a politically feasible thing.
Revenue feasible.
Yeah, or revenue.
Let me take 2 more questions and then we'll call it a day. Yeah.
I just want to emphasize Jim's point. So I think one thing we always think about, we always just have the rearview mirror, right? And we think what happened in '86 is that's our last reference point. But I mean, thinking through like how the fiscal crisis could play out. I mean, you could have 2 obvious things are you could have the government basically decides to repudiate the debt by having high inflation. That under our current tax system, that's going to, which is only...
Yeah, I think that's quite likely, by the way. I agree with Larry on that.
That's likely to create the salient things that determine what the reform is going to be at that point. Because, the depreciation will be like, all completely screwed up. It's basically taken away. Like, they've already lost their base. But seriously, the other scenario, which is very unlikely because of Bernanke's rearview mirror, it's looking at the Depression, right, is a debt deflation scenario, right? So the Fed pulls a line, interest rates go way up because of the imbalances. Housing markets go seriously south. People have these huge losses that they can't use, and the tax system is being blocked by all these old things, some of which were designed to block tax shelters. So, in many ways, if you're writing this paper, one thing to think about is what would happen in these different scenarios. That would create the immediate environment for tax reform. It could have a very big, dramatic impact on which reform is chosen.
Yeah, that's interesting, and I think I do want to kind of add that to the picture. I was just going to say, I kind of think of inflation as a big part of the story. You inflate away the debt, you de-index the tax code, you kind of de-index a bit Social Security, you somehow cap Medicare so that it's effectively not indexed anymore, and that strikes me as a politically not a very, I'm not quite sure how that would be done with Medicare, but if you could somehow, I guess via the price is see it. What?
What's going to happen with an independent Federalist?
Well, they're independent because Congress says they're independent.
What's that?
They're independent because Congress says they're independent. Congress could take it away tomorrow. Yeah, so you have CMS pay, not keep up with the reimbursement rates, and then essentially Medicare, people go off it because doctors don't want to do it. It becomes like Medicaid today in some places.
Last question, Ed.
So sort of on this point in kind of a contrarian outside-the-box thing, partly initially suggested by George's comment about the AMT and the failure to index, I wonder if that's really not such a bad thing. I think you can maybe go back and say it was indexing in the 80s, which of course gets deferred effectively until 1990, that was sort of at the root of the current problem, because it's very hard to raise taxes. We had no peacetime increases in marginal tax rates until after indexing went in. When you didn't have indexing, you kept naturally getting an increase in tax revenues, which meant that a lot of tax reform could actually be revenue non-neutral in giving money away. We've got on the expenditure side, which sort of undercuts the perceived regressivity, of course, the fact that 40% of people are off the income taxes also undercuts the perceived regressivity. But on the expenditure side, we've got hyperinflation because the benefits are increasing at higher than inflation. And I wonder if it's really not, such a bad policy to it's a way of raising taxes to go back to non-indexing of individual tax rates. And it's an alternative to all these other things.
If I could just make a quick comment, I don't think I agree with that. And I think if you look at the history of the 60s and 70s when we had the automatic increases, what Congress did is and what expected is every year was a tax cut, and it was for selected folks because they had the luxury of having this automatic increase behind them, which they never had to.
I mean, we still have every year a tax cut.
Well, but I think at least now there's a little bit more. I mean, because of the indexing feature, there's a little bit more pressure on them.
The final thing would just that's comment is it would make the people more concerned about inflation. It would get the people on the side of anti-inflation.
Yeah, I've thought of Jeff's scenario as kind of not what I'm supposed to write about in the paper, but I think I can accommodate a little bit. It is interesting and worth. It's like that's what's actually going to happen rather than what I'm supposed to write about. But it's worth thinking about a little bit.
I don't know, the notion of introducing bad policy so that the politics might improve is an intriguing one. And I think has some points.
Well, on that optimistic note, I think we'll end this session. Thank you.